Imagine waking up one morning to find that your safe bond investment has just lost 31% of its value. Not a stock portfolio, not cryptocurrency, bonds. The thing your financial advisor told you was safe. This actually happened in 2022. And while bond investors watched their portfolios crater, people with high-yield savings accounts slept soundly, their principal completely intact. Today, we're diving deep into one of the most misunderstood questions in personal finance. Where is your money actually safer? And I promise you the answer might shock you. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Let me take you back to March 2020. The world is shutting down. COVID is spreading. Markets are in free fall. You'd think this would be the moment when bonds shine, right? They're supposed to be the safe haven when stocks collapse. But here's what actually happened. Government bond ETFs started trading at discounts of about 0.5% below their actual value. Investment-grade corporate bond ETFs, they fell about 2% below their net asset value. And high-yield bond ETFs, some crashed over 9% below what they were actually worth. The liquidity that bond ETFs promised, that supposed advantage of being able to sell anytime, vanished exactly when investors needed it most. Meanwhile, every single person with money in an FDIC-insured high-yield savings account had complete access to 100% of their principal. Not 99%, not 91%, 100%. But March 2020 was just the opening act. Let me tell you about 2022, the worst year for bonds in modern history. Picture this. The Federal Reserve is raising interest rates aggressively to fight inflation. Everyone knows rates are going up, but most investors don't understand what that means for their bond ETFs. The Vanguard Total Bond Market ETF, ticker BND, which tracks the Bloomberg U.S. Aggregate Bond Index, fell 13.11% that year. 13%! This is supposed to be one of the safest, most diversified bond funds in existence. But it gets worse. Long-term Treasury bond ETFs like the iShares 20-plus year Treasury bond ETF, ticker TLT, absolutely collapsed, dropping 31.4% in 2022. Let me repeat that. U.S. Treasury bonds, backed by the full faith and credit of the United States government, lost nearly one-third of their value in a single year. Not because the government was going to default, not because of any crisis, simply because interest rates went up. And here's the kicker. While all this carnage was happening in the bond market, high-yield savings accounts remained completely stable. Your $10,000 stayed $10,000. Why did this happen? It all comes down to something called duration, and understanding this concept is absolutely critical. Duration measures how sensitive a bond or bond fund is to interest rate changes. A bond ETF with a duration of 2 years will lose approximately 2% in value if interest rates rise by 1%. A bond ETF with a duration of 6 years? It'll lose about 6%. Long-term bond ETFs with durations of 15 to 20 years can experience devastating losses when rates spike, which is exactly what we saw in 2022. High-yield savings accounts have zero duration risk. Zero. Whether rates are at 0.5% or 5%, your principal never changes. Just when bond investors thought they'd survived the worst, March 2023 arrived with a new nightmare. Banks started failing. Silicon Valley Bank collapsed on March 10, 2023. Signature Bank failed on March 12th. First Republic Bank was sold to J.P. Morgan Chase on May 1st. This was a full-blown banking crisis. But here's what's fascinating. Depositors at FDIC-insured institutions experienced zero losses on insured deposits. The FDIC protection worked exactly as designed. The government even stepped in to make uninsured depositors whole due to systemic risk concerns. The system held. Meanwhile, bond ETF investors were still reeling from elevated interest rates, still sitting on losses, still exposed to market volatility. So let's talk about what safety actually means, because this is where most people get confused. High-yield savings accounts offer absolute principal protection. Your money will never decrease in value, period. With FDIC insurance backing deposits up to $250,000 per depositor per bank, you're protected by the full faith and credit of the U.S. government. As of November 23, 2025, top high-yield savings accounts are paying 4 to 5% APY. That's real money with zero risk to your principal. Bond ETFs have zero principal guarantee. While they offer exposure to bonds and can provide competitive yields ranging from 3.4 to 5.8% depending on the type, your principal fluctuates daily based on market conditions. You can, and likely will, at some point see the value of your investment decline. Bond ETFs expose you to credit risk, especially for corporate and high-yield bond ETFs. They carry liquidity risk that becomes painfully real during market stress. There's NAV deviation risk, where the ETF price disconnects from underlying bond values. And there's reinvestment risk as bonds mature and are replaced at potentially lower yields. Let's talk about liquidity, because this is one of the biggest myths about bond ETFs. Both options claim to be liquid, but the reality is dramatically different. High-yield savings accounts give you immediate access via ACH, transfer, wire, or debit card. There are no transaction costs or penalties. Your full value is available regardless of market conditions, typically settling within 1 to 3 business days. Bond ETFs trade during market hours like stocks. You're subject to bid-ask spreads, which are transaction costs that eat into your returns. You may need to sell at a loss if markets are down. And here's the critical part that March 2020 exposed. Bond ETFs can face structural liquidity issues during crises when market makers step back. The liquidity that's supposed to be there can become an illusion precisely when you need it most. Now, as of November 2025, we're in a fascinating and unusual market environment. The 10-year U.S. Treasury yield sits at approximately 4.1%. High-yield savings accounts are paying 4 to 5% with zero risk. Short-term Treasury ETFs yield around 4.4% with minimal but non-zero risk. Intermediate bond ETFs yield about 3.7 to 4% with moderate risk. Long-term Treasury ETFs yield around 4.5 to 4.9% but carry high interest rate risk. Do you see the problem? The yield curve is inverted, meaning you can get better rates in a savings account or short-term instruments than in longer-term bonds without taking on duration risk. This is historically unusual and makes the case for bond ETFs weaker than normal for anyone prioritizing safety. So when does each option make sense? Choose high-yield savings accounts for emergency funds covering 3 to 12 months of expenses. Use them for short-term goals 0 to 3 years out. Park money you absolutely cannot afford to lose in savings accounts. If you're in or near retirement and can't recover from losses, savings accounts are your friend. Choose them when you want maximum safety and peace of mind. Bond ETFs, on the other hand, make sense for long-term portfolios spanning 5 to 10 plus years. They provide diversification alongside stocks. Use them when you can tolerate short-term losses for potential long-term gains. They're useful for positioning for interest rate declines because bond prices rise when rates fall. And they can offer tax advantages in certain situations, particularly with Treasury bond ETFs that provide state and local tax exemptions. Here's the bottom line, the verdict based on all the evidence we've examined. For pure safety, defined as preservation of principal, high-yield savings accounts win decisively. You get zero principal loss in any scenario. You have FDIC insurance up to $250,000. There's no market volatility. You get immediate liquidity without transaction costs. And they have a proven track record through multiple crises. March 2020, the 2022 rate hikes, and the March 2023 banking crisis. Every single time, FDIC-insured deposits held firm. Bond ETFs serve a different purpose entirely. They're investment vehicles designed for long-term portfolios where short-term volatility is acceptable in exchange for potential returns, diversification benefits, and positioning for different rate environments. The 2022 bond market collapse provided a brutal stress test. Aggregate bond funds fell 13.11%. Long-term Treasury ETFs crashed 31.4%. Investment-grade corporate bonds suffered significant losses. Meanwhile, FDIC-insured accounts protected every dollar up to the limit, completely unaffected by the market turmoil. The following year's banking crisis reinforced this lesson. When banks failed in March 2023, depositors' money was safe up to FDIC limits. If your question is, where will my money be safest, especially for emergency funds or short-term needs, high-yield savings accounts are the clear answer. Bond ETFs have their place in diversified long-term portfolios, but calling them safe misunderstands their fundamental nature and the very real risks they carry. The safest investment isn't the one with the highest yield, it's the one that's still there, at full value, when you need it. And that's a lesson worth remembering. If this video helped you understand where your money is truly safe, hit that like button and subscribe. Drop a comment below and tell me, are you Team Savings Account or Team Bond ETF? This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.